And hello, Professor Wesley Gray.
Hello, hello, hello. What an exciting day for our podcast to have Wesley on. What an honor. Wes, hey.
Yeah, we've been waiting a long time to get you here, Wesley. Thank you very much for coming. We don't have a lot of time with you, so we would like to use most of the time to pick your brain, your very interesting and unique brain. So, guys, we're going to skip the quotes. We're going to skip the recommendation in the end. We're going to talk straight investment. I'm just going to give a quick disclosure that we must do. This is only for knowledge purposes. No recommendation is here. Don't take it as any recommendation. If you need to do something, you need specific counsel regarding to your own situation. Should take it into consideration. And we all have position in the market that you need to take into consideration. Yoav, the floor is yours.
Wes is the floor. I'll just give a little background how I had the honor of meeting Wes, and we'll take it from there. First of all, Professor Gray has published how many books on investing?
Gee, I have three books, three published books, and then a bunch of academic papers. So,
Including about this your stint in the army, which you might want to talk about, right? You gave
yeah,
me
yeah,
that
that,
personally
that's
as a thought.
that's another book, but it's not about finance. So,
Okay, so when a person doesn't remember how many books he's written, you understand that what kind of person we're talking about here. So all of us wish we had that problem. Anyway, Professor Gray is the head of the company. I'll let you talk what you do today, and then I'll take
sure.
maybe about the background. You go ahead, Professor. Sorry.
Yeah, yeah. So we kind of have two core businesses right now. Like we have Alpha Architect, which is our business that does like our own intellectual property, our own SMA, RA business. And then we run our own ETFs. And then we have another firm called ETF Architect, which is basically like an infrastructure company. So we run at this point, I think the infrastructure and back office for 71 ETFs, and where
Hmm.
other people just, they tell us what to do and market, distribute, but we do all the infrastructure. So we kind of have two businesses, a shovel selling business and then the Alpha Architect business.
Amazing. I'll give some background about the ETF business, why it's so special. By the way, my first introduction to you was after I read, I think, your book, Quantitative Value, which you wrote together with Tobias, which we'll talk about. I reached out to somebody on your team. I had some questions.
Hmm.
And he said, "Oh, give us a call one day." And I think I gave a call. It was a Friday, and I called your firm. And then one guy says, and two of you answer, and one of them was apparently you. And I was like, just starting off as an investor, and you yourself answered the phone. For me, that was like aha moment. Anyway, we discussed then something I didn't know, and now as a money manager myself, the tax implications, and just people, our audience knows, in the States, a mutual fund, Keren Neemanut, is tax advantage. In the States, if a mutual fund, to correct the wrong, Professor, is the tax advantages are nil. So even so,
Yeah.
you're pretty bad. If you want to get the tax advantage, you open ETF. So you kind of give this service for money managers who want a friendly tax structure. But for Israelis, we mutual funds here are taxed the way ETFs are in the States pretty much. So it's much easier, just so you know.
Yeah.
Anyway,
Yeah.
so not only did I get to talk to you, but you actually invited me to your offices 10 years ago, which is, again, for me as a money manager today, the fact that you were so kind enough to have me over, and I went all the way on the train to Philadelphia to meet you and your team it's very, very, it was very meaningful for me, and you've had huge impact on our work, and the fact that we have a podcast today and the whole spiel, and to have you here is again a great honor. Um, why don't we start about your background, maybe, Professor? Tell us about how you got into the field and your special story, and then we'll start picking your brain.
Yeah, yeah, sure. I'll give you the down and dirty version. Because I had a convoluted path, but so basically, I started investing as essentially like a stock picker way back in the day in '98, where I thought I was going to be Warren Buffett. Fast forward, had some good times, had some bad times. Launched a hedge fund in 2008 at September, the worst time ever. So I've had like a
Wow.
crazy ride, but essentially background is so I was in undergrad and then I went right into a PhD program at University of Chicago, entered in 2002. And then I actually left in 2004 because I was in the service. So I was in the Marine Corps for 4 years, kind of took a sabbatical, came back in '08, and, and as that I started finishing up my PhD, that's also when I had the bad idea of launching a hedge fund, in September '08. So I was doing,
Tell
finishing
tell
up
us who
my,
you did you're too honest. Who you did your PhD with? Who was your
so I got to hang out with a bunch of famous people, but Eugene Fama was one of my main advisors there. Pietrosi Veronesi and a bunch of other people that are they're famous within academic circles, but not in like the normal world. But obviously Fama's super famous. And, because after the fact, he obviously won the Nobel Prize. I didn't know that was going to happen. So when he was talking to me, he was less famous. But, all good. But, so I came back after the service,
Wait, and
finished.
you served, sorry, I cut you off again. You served in this neighborhood, if correct if I'm mistaken. You actually wrote a book about it too.
Yeah, yep. So I used to live in Haditha, Iraq, which is out
Great
there in
neighborhood.
Euphrates. Yeah, great neighborhood. Almost as safe as Philadelphia. But yeah, so I used to get to hang out with the Arabs and the Iraqis. Did that. Obviously, that was a total different world than financial markets and doing a PhD. But I thought it was a good experience, just for other parts of life.
Why did you do it?
So I had always just wanted to do my service generically, and it was just, it's a matter of like timing in my life. Where originally I was like, all right,
Why
after
did
high
you want
school,
to do your service?
I don't know. I just always liked like America, I like freedom. I just like what everything stood for, and I just felt like, if you don't do your time, who's going to do it? Like someone's got to do this, to pay
Hmm.
respects to the country. And if everyone just says, oh, I don't want to like do any work, well then, then it's never going to work. So I just felt like it was an obligation that I had to do.
In Israel,
Wow.
by the way, the army service is mandatory for most people, so you know that,
Yeah.
yeah.
Yeah, exactly. Most other countries, that's kind of like an intuitive thing. But, in the States, it's not mandatory. And so it's kind of relies on people just, rogering up to do it. And, obviously there's not a lot of people that do that, but I think there's, enough of us out there that are doing it that it seems to work. So, it's just like if you're in Israel, I think most people are like, well, of course, like, I mean, I gotta,
No,
if I want to protect
for
the,
us, for
it's
us, it's
part of the
very
deal.
commendable to see someone that can do a lot of good for himself chose to do service for others. It's commendable.
Yeah, so it was just something I always wanted to do. And in my PhD program, actually, weirdly, a lot of the program was actually former Israeli officers and military, like few military enlisted guys as well. And so when I mentioned this, because I was talking to them about their thoughts, because they'd obviously been in the military and then also entered into the PhD world, they were all like, well, of course you would do that. Because a lot of people think it's like very weird. I was like, well, you don't know who I went to school with in the PhD lab. They were all like, well, of course you would do your service and do that because that's a great life experience. So I had a unique exposure to like this guy named Zahi Ben David, Effie Ben Malek, like all these guys that are now famous professors, but they're former like IDF either officers or enlisted guys. Also Gil Sadka. It was just weird that when I was in, a lot of my PhD classmates were, in the military prior. There was another guy who was like a Finnish sniper. I was the only American. Maybe there's two other Americans, but as you guys know, most other countries, it's kind of obligation that you join the service. So they just thought that
But
was normal.
but I would like to ask you one question that's very interesting to me. I mean,
Sure.
University of Chicago and Eugene Pharma, they're considered to be the temple of the efficient market hypothesis and
Yeah.
her grown-up child of the passive investing and indexing ideas. I mean, usually when we talk about to people who are John Bogle followers, are they quoting Eugene Pharma and this hypothesis, they're telling us there is no room for value investing. And you chose value after you studied it so deeply. Why?
Yeah.
This was your doctorate thesis, if I believe, as well. This is what you did your.
Yep. So yes, so the efficient market hypothesis is basically just stating that like, hey, prices are correct. i.e. the risk reward is commensurate with whatever you buy, right? And so a lot of like Bogle fans say, oh, that just means you should just buy like an index-based fund. But that's not what the efficient market says, because you know there's an argument, and this is the argument actually, frankly, that Fama himself makes. And okay, the reason you buy value stocks and the reason they earn higher expected returns is because they have some fundamental higher risk, right? So Eugene Fama himself would I would say in expectations suggest to you that value stocks will earn higher returns over the long haul. I'm talking like 20, 30 years on average. And he would say, but that's okay because they're higher risk, right? They're in industries that are, you know, more susceptible to disruption. You know, maybe they got issues in their business or whatever. And so the reason that those stocks earn higher returns on average over a long time is because they have fundamental risk to them, right? So that's totally in line with the efficient market hypothesis. That's what Eugene Fama himself states. And it does not say that the only solution is to buy a market cap weighted index fund. Now, of course, there's a lot of debate on that. Well, okay, some people say that value stocks earn higher returns over the long haul on average because of more risk, but some people say because it's mispricing. And this is an endless debate that will go on for the rest of eternity because they're still arguing about this. You know, and I left that place like 20 years ago, and it's still like argument. I think what everyone agrees is that we'll never know. We're just going to argue about it. But it's probably a mix of both. There's probably some extra risk. There's probably some mispricing. But as we've seen in real time, and as we know over history, the reason that those things exist, it's not like it's super easy to arbitrage, right? If you buy value stocks, it's not like you're going to print money every single day and it's easy to do. It requires a lot of discipline. You have to be the strong hand. You got to think in terms of decades, not like a year or two. It's just not intuitive to a lot of people. But I think it is intuitive that, you know, buying cheap stocks that don't look pretty and that have way higher earnings yields and way lower prices should earn higher returns over the long haul. I don't think that's even controversial
But you
for
are,
Fama.
but I also suspect that you have something of a rebel inside of you, because even among the value school, you're not a classical value at all, and you adhere to something that might, maybe in Omaha, they will call you a heathen for choosing momentum strategies and all sorts of things that are not exactly the value cup.
Yeah. So I am I'm very ingrained in value because that just intuitively makes sense to me, right? Like, hey, I look at a stock, it's a business. You know, all else equal, if two businesses are roughly equal quality, I'd want to buy the one that's cheaper. That just makes sense to me, right? And we can build systems to do that mechanically, which I like to do because I don't like to get too involved with my monkey brain. However, just because you believe in value, you know, at some level, I'm also like an academic and someone who studies all this research and all these different ideas. And so it took me a long time to get around to this, but I just didn't want to be dogmatic about there's one religion of how you have to invest and let's only do that. And so over time, I've learned to accept like, hey, there's probably momentum in markets. There's probably trend in markets. I could be convinced of many things in the marketplace. And so just it's taken me a while, but I think there's a lot of good ideas out there and we should probably, you know, do all of them to some level to the extent you're comfortable with those approaches.
Wesley might be happy to hear that. I remember also we spoke about it, but I was lucky enough when the strategy we adapted, Voris, thanks a lot to your studies and Mr. Carlisle's, is we take remember we spoke about the small cap previous still existed. So we do in one strategy, remember there are two, I'll explain to our audience there. You can do value stocks separately, you can do momentum separately, you can find stocks that are both cheap and have a momentum tilt to them, and you can do that on various market cap stocks. So we do small cap value momentum together with profitability, and it's actually, despite a very rough patch for small cap value in the States, it's done pretty well. So there are a few ways to do it. Maybe you want to talk about a little bit about your book. You wrote one of the few books that talks about the magic formula and that kind of strategy. You found something interesting about the magic formula, that there are two factors there. Maybe you want to tell us more about that. And actually, one of them deters from the returns with the magic formula. So you want to tell us about that, a little about what you wrote about in the book? What's the best factor?
Yeah, sure. So, so first, like the strategy you guys are operating makes a lot of sense, right? Small, value, quality, momentum, all makes sense, right? How you bake this cake, it doesn't really matter as long as you have like the right recipes and you're putting them together in a roughly sensible way. Those are all good ideas, and so I commend you for incorporating a lot of good ideas and not being dogmatic about one single thing. So basically going back, I don't even know, 13 years now, whenever the heck quantitative value was around, there's value and quality, right? And so there's two ways you could do it. Like the magic formula suggested, hey, we should kind of think more through the lens of Warren Buffett, where let's just do 50% on a valuation metric and 50% on quality, because you might get a firm like, See's Candy back in the day where, hey, it's more expensive, but it's insanely high quality. That's a good value. You might also find a stock that sells for, I don't know, 5 PE ratio, but it's not as high quality. That's like a really cheap firm, but it's so cheap, even though it doesn't have a lot of quality, it's also good value, right? So intuitively, a 50-50 strategy kind of makes sense, because then you could buy stocks across the spectrum that just have the best kind of quotient between value, or price, cheapness, and like their quality. However, what we kind of, that doesn't even align with economic theory or like the theory of factors or mispricing. The key thing, like even if you go back to like the risk-based hypothesis, an efficient market hypothesis, one wouldn't expect that if I just looked across the spectrum of like value and quality, that anything would be mispriced. Because like, why would that be the case? That's just how markets should price things. However, within value, particularly cheapness, the reason things are cheap is because the prices have gone down a lot relative to fundamental. And necessarily the market's telling you this is risky, is one angle of thinking about this. And that's why it's so cheap. So if you just focus on just the cheapest of the cheap, those are the securities where, in expectation, whether you're an efficient market hypothesis or like a behavioral mispricing person, we all agree that those stocks should earn the highest returns, where there is not even a theory of why, a good theory that's agreed upon, why like value and quality 50-50 would make any sense. I mean, it may back test well, but there's no like kind of like core logic. There's definitely a core logic that regardless of who you talk about, cheap, nasty, ugly, the dirt ball stocks that are like so cheap, everybody hates them. We all agree for different reasons that they should earn higher expected returns, right?
Would you agree on small caps even more? Sorry to disrupt you. On small caps even more, would you agree with that if you do value in small caps?
No, what I would agree with is that the cheapest stocks are all that matters. Jack has a paper that clarifies this. So to the extent that smaller stocks have even cheaper stocks, yes. But for example, just to make sure the logic is clear there, if I have a bunch of, let's say, small stocks that have on average a PE ratio of 20, and a bunch of mega cap stocks that on average have a PE ratio of 5, I'm going for the mega caps, right? But on average, and empirically, what happens in the data sets is that usually the bigger stocks, just if you look at the cheap stocks within the biggest stocks, maybe they're only like a PE of 10, but the small cap world, it allows you to get maybe PE of 5. So there's a little bit of confusion of its size as a factor is generically kind of shown to not be a driver of returns. However, if size also happens to proxy where you can find even cheaper stocks, then you would think it would work. But it's not because it's small. It's because you can get even cheaper stocks in the smaller caps versus like the mid and large caps. Would be the logic. Yeah.
So sorry, so what's gone wrong for the past 13 years, or is this part of the plan? That's why value works.
Before you go to what goes wrong,
Yeah.
let me recap what you said to make sure that everybody understand. Because basically what you're saying is it's better to buy cheap stocks than good stocks.
Yes. If you're looking for long-term higher expected returns. Yeah.
So why didn't it work?
Yeah. So in the last, well, it depends on where you are, but like over the last, I don't know, call it 10 to 20 years. Well, let's go back to why generically why it usually works on average, right? So the general theory of this is that, okay, cheaper stocks, we already know over, well, I'm talking like 100, 200-year samples in every market, blah, 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 generically earn higher long-term returns than more expensive stocks, right? And the argument for that is like, okay, more risk or more mispricing. So, and let's just do the mispricing one. The mispricing one says, yeah, it's like, okay, these cheap stocks are obviously cheap for a reason. But the reason they outperform on average is that they're priced so cheap that when the fundamentals come out, and the fundamentals are not going to say this is Google. The fundamentals are going to say this is not bankrupt. And that change in differences between what the priced fundamental is and what actually comes out, these are not superhero companies. They just come out to be, oh, they're not as bad as we thought. That's where you get that valuation gap and that change in expectation that usually drives the quote unquote excess returns, right? And so
Basically, just let me clarify. Basically, you're saying people so much dislike bad things that they will sell it it's so cheap that it's good to buy. It's
yeah,
too bad to be
exactly.
true. It's too
Yeah,
bad to be
yeah,
true.
exactly. They priced
The
it.
human conditions are they don't like bad things, so they don't like ugly things. When they're
Yeah.
bad, you just sell it so cheap that this is probably the best thing is to buy from them.
Yeah, exactly. It's basically price below expectations. But on average, historically, what you see is that, you know, over like say the next 3 to 5 years, that it's never as bad on average as people think. And when the revision changes, that's where you earn the kick in excess returns, right?
Too
However,
bad to be true.
yeah, exactly. However, it's an on average effect that doesn't happen all the time. And so what's happened probably, one could argue, and now we know because we can look at the data, is like, let's go fast forward, like, or reel the tape back, I don't know, 10 to 15 years, right? Cheap stocks versus growth stocks. Growth stocks, and this has happened historically before, but generically the stocks that were priced the most expensive, call it 10, 15 years ago, they were priced the most expensive because the expectation was that their earnings and their fundamentals were gonna be outstanding. Well, it turned out to be the case that those stocks actually not only were outstanding in their earnings growth, but they were better than expected, which is why weirdly in this last 10 to 15-year period, you know, the most expensive stocks actually earned even higher returns than they've done historically because their fundamentals outperformed what was even expected of them in the first place. And similarly, on the value side, those cheap dirtball stocks, let's say 10, 15 years ago, and you can roll the tape forward from them, in general, yes, they were priced at like not great, right? The problem is it turned out that when the earnings and the fundamentals came out, now this has been changing the last few years because value's been doing a little bit better than expected because the fundamentals have been kind of reverting. But on average over time, these value kind of cheap, crappy companies actually performed in line with as they were priced, right? Or they even did shittier than they were priced, right? So that's why they
can't you
underperformed.
argue that the information revolution that we have been through in the last 20 years, when information is far more vast, immediately, and processed much quicker, allows markets to price companies better?
I mean, you could argue that, but that wouldn't explain why growth stocks earned even higher returns than expected and value stocks earned even lower returns than expected. You would think that they would be priced correctly, right? And I don't think there's anyone that would argue that like it would have been priced for perfection. And again, the main reason is the argument on the information. Let's say the markets have perfect information, right? In general, if market, let's just say on a go forward basis, like AI is perfect, like everyone is God, every stock is perfectly priced on a risk adjusted basis for like the net present value of its, you know, cash flows into the future, risk adjusted for how much pain and anguish it is, right? So in expectation though, from a go forward basis, would we expect Mag 7 to have higher expected returns than, let's call it dirtball 20, whatever's in that, right? The cheapest stocks. If the market is perfectly priced, we would expect Mag 7, those are lower risk, more solid cash flows because they're higher margin business that do great and the market's perfectly pricing them. We would not expect them to earn higher returns than dirtball 20 right now. A perfectly rational, efficient market machine would not say that. Like, because why would you get to earn higher returns by owning high margin, high profitability, lower risk cash flow companies? You should earn lower returns because people would prefer to own them because they're less volatile. Whereas like the dirtball 20, those are the firms that are maybe higher bankruptcy risk, higher cash flow volatility risk. You have to earn higher returns.
It's like saying, just to make sure I understand you and our listeners can understand, basically you're saying an apartment in Manhattan should be in cap rate of 2%, while you're buying in Mexico, maybe you will need to pay 15%.
Exactly. You got it. On a go-forward basis, assuming perfectness. And the only way in which, let's call it, the most expensive securities could continue to do what they've done over the last 15, 20 years is they have to, it's not good enough that like NVIDIA is a really great chip manufacturer that has insane earnings. It has to have even more insane earnings than is already priced for it to continue to outperform the, let's call it the dirtball 20. To your point, right? Like we'd have to have the New York Manhattan apartment, which is nice, stable. We know everyone wants to own those forever. Go from a cap rate of 2 to a cap rate of 1 because people liked it even more than they liked in the past, right? And so even with perfect information, if we thought prices were absolutely stunning and accurate, you have to think that like the Mexico beachfront property is going to probably earn higher returns on average than the New York apartment, using our analogy here, but you could apply that to the securities market. So
you can apply to the Israeli real estate market as well. That's what happened. The New York example is what would work for here for now, but people don't understand that. After all,
and you've seen that in our U.S. stock market where there's also just there's fundamentals, but then there's the valuations and the multiples paid for those fundamentals. So what you've seen on gross, and that cannot go on forever, right? So what you've seen is like the most expensive stocks, yes, they did great fundamentally, but not only that, people are paying more for those fundamentals because they expect them to continue to be even better than they thought they might have been in the past. So i.e., the New York real estate went from 2% cap rate, and it actually, for the same rent rate, now they do 1% cap rate. Whereas on the kind of the value-y stocks, you've actually seen improvements in fundamentals, but that doesn't, people aren't paying up more for those. In some senses, they're in some cases actually paying less for those, even though they're doing better than expected. So eventually these things kind of mean revert, but it could take another 20 years. The go-go.
So in response to my questions, what I learned is, yes, maybe the markets interpret information quickly and more efficiently and more thoroughly and doing it better, but but the meaning of it's just that the process is going to be longer in order to reverse.
Yes, if you wanted to assume that, I think there's a lot of market intel that suggests that in many cases you can make a strong argument that the markets have become less efficient. Right. And you see that with like these meme stocks, this manipulation in different market prices where you're like, how is GameStop, it's not like $100 where it's like billions of dollars, and it just doesn't make any sense. Right. And you see this all over the marketplace where like things that you would think would be crazy 10, 20 years ago happen. Like, I mean, it makes no sense. So I think people could make just as much argument that mispricing and behavior has massive influence in market prices right now, even maybe more so because people can execute, they can trade, it's free to do so. And like it seems, I don't know, but whether you assume markets are perfectly efficient with information or you assume people are completely insane and crazy, regardless, it should be the case in the long game, assuming that fundamentals matter at some point, which I think they do, that cheap securities on a go-forward basis shouldn't earn higher returns than more expensive securities.
Tell us, please, two questions if I can
Yeah.
follow up to that. First of all, let's talk more practically, and then we'll talk about a bit about your strategy. Practically, people today have a lot of investments in the S&P 500, also Israelis. What would be, without, of course, investment advice, what would be alternatives that you would suggest today? I know you love international stocks, small caps. Where are you?
Yeah.
And how would you invest in these if not via ETFs or whatever?
Yeah. So my framework is to analyze the world through like the lens of factors and what we know about expected returns, right? And that it's regardless if we're investing stock. So what is the S&P 500 through the lens of how academics would look at it? Well, right now, the S&P 500 is obviously a mega cap growth quality factor. Because that's what it is, right? If you kind of throw away the labels on these stupid things, that portfolio of securities, what are the characteristics that highlight what it is? Well, it's mega cap. It's the biggest of the stocks that are out there in the marketplace. It's growth, where academics growth means expensively priced. It obviously is expensively priced, and it is high quality. Obviously, like the quality dynamics of like a lot of the firms in the S&P are much higher than average. However, we can go back and ask the question, well, if we have a portfolio of securities with the following characteristics, super mega cap, really expensive and high quality, how do we expect those to earn from an expected return standpoint on a go-forward basis? Answer, not that great. But if you like that exposure, fine. But if your goal is to earn high returns over the long haul and you have to bet today for the future, what do we know on general earns higher expected returns? What are the characteristics we'd want to focus on? Well, we already talked about them. Maybe value, profitability, momentum, size, all these sort of things. So you'd want to form portfolios if that was your goal to earn higher expected returns in the future. You'd want to own baskets of securities that do that. And so those might be an international, right? Like obviously international versus the US, at the margin, you could probably find baskets of securities that are really cheap, decent quality, et cetera. And you would expect that those securities on average would probably do better than say S&P 500, right? S&P 500, the good news about S&P 500 is it's going to track S&P 500. But the bad news is in expectation. And if you just do the math on it and you think through it, like the absolute returns on that portfolio is expected to be pretty bad. It's just math. Unless you thought the PE is going to double again and their earnings are good, it's just
But
crazy.
I'll give you a question. Not that this is my opinion, but I think some of our listeners have that opinion and I want to represent it here.
Yeah.
Someone might argue, if you go back to 2019, it was the same thing. It was a mega cap, quality, high priced.
Yeah.
So you said you won't expect for a good return, and we are 6 years after, and the market is, I don't know if it's doubled or more or even tripled.
Yeah.
Gilad, the guy that wrote the paper, even God would get fired as an active manager. I think we have him right here. He might explain that these things take time.
So exactly. The problem is all of this is about expectations, like on average over time. But obviously, if someone wanted to say, hey, I am all in, I'm triple lever in the S&P 500 from here forward, I would say, great. Why? And if they said, well, I'll tell you why. Because right now, if we look at the Mag 7, the profit margin earning growth, I'll just make this up, is 25%. I think because of X, Y, and Z, it's going to be 50%. The market just does not appreciate just how dominant these firms are going to be. That's a logical reason to own the S&P 500 at like a PE ratio of 35 and all the the gravity weighing against you. I could buy that argument. Like I'd have to be convinced that the logic, but that's the only logical way in which that you could get to the case of why you'd want to invest all your money triple levered in S&P 500 right now, right? And I could be convinced of that, but I don't think most people are thinking like that. Most people are like, well, why do you want to own the S&P or the triple Qs? Well, because you see how well they performed the last 20 years. They're amazing. That's not logic. That's called being an idiot, right? Logically, they will outperform go forward if and only if that their earnings growth and their fundamentals outstrip expectations and the market continues to value it at high rewards or even higher than it's currently being rewarded. Other than that, it's impossible for them to outperform. And they're not going to outperform over the long haul just because they outperformed in the past. If
One
anything, it's the
might
opposite.
argue that, yeah, but maybe those stocks won't grow that much, but other stocks will grow that much, and they will be growing up, and they will produce the returns.
And that would be great. But you wouldn't want to buy the SP 500 if you had that knowledge, maybe to want to set up like, I don't know, let's say they say, well, I think you're right. The mega cap, tech companies, they're going to get killed because government's going to start putting rules on them. They're too monopolistic, whatever. But I think the mid cap ones that are smaller and higher quality, their earnings estimations right now are, they're really expensive and it's projected to be 25% growth. I think they're going to be 50. Great. Don't own S&P, own a mid cap S&P, quality tech product, whatever it is.
But they would say, and I think this is a
Yeah.
very good argument to sharpen the
Yeah.
thinking. They would say, well, but I don't know. I want to be passive about all the market, and I want to get the average. This one will go up, the other one will go down. I don't want. I want simple life. I want it easy, and I want to get. And maybe this one won't, and the others by buying all the market are getting all the economic of the U.S. and all the growth.
And that's totally a reasonable approach, right? And especially because there's another component like taxes, frictional costs, fees, all these issues, they can kill any good investment, right? So one of the beauties of what you just mentioned there is at least I'm guaranteeing myself not being self-destructed in like behavioral problems because I know I'm going to get the S&P because I own the S&P. And usually in general, like taxes are low, fees are low, all these sort of things. And yes, it's true. You will get to participate in the average of whatever currently is like the mega cap growth quality factor. And that's awesome. But if you want to try to earn higher expected returns than that, unfortunately, you're going to have to be different. And you got to make sure that however you go after that, you got to also worry about the taxes, fees, and all these other things, because, if on average you're different, you make an extra 2%, but it costs you 3% in frictional cost. Well, now we go back to the logic of just go buy the Vanguard fund, right? But if you say like, hey, I've got 20 years and I believe that, owning this style of portfolio has, I don't know, 2% edge on average over the next 20 years. And I think I can capture that with 1% additional cost, then logically that would make sense. Otherwise, if you can't do that, or to your point, you're just like, you know what, way too much brain damage. I just want to go to bed. You could also do that. That's why there's a marketplace. And that's
I would like to add another answer to this question also is that, that because of all the passive attitude today, I would assume that at some point when the expectation will not be met, we will see a terrible downsize like we had throughout, the beginning of 2000 or 87 or the beginning of the 70s or even 2008. And I think that all the people that went in from the wrong reasons, as you mentioned, that just I'm going in because it did good in the past, will go out as fast as they come in, and you will get a sharp decline. And psychologically, people tend to do mistakes with investments. I mean, it's the default mode of a human being is to make bad investment decision because you should do the counter to what you're intuitive. I mean, human beings are not programmed to make good investment decisions.
Gilad, that's exactly what I want. If I may follow you up with what I want to ask, was maybe that's a follow-up question. Why? And if you could explain why you're a quant, what that means for you, and why you're very different from a lot of the other money managers we've had here, who are more actively and that you do it on a quant and you don't want to deal with the brain damage, as you call it.
Why aren't you classical value?
Exactly.
Like Charlie Munger, Warren Buffett in the last 20 years, 30 years, or 40 years, like buying good stock with good prices and just holding them. Why do you need all this quant?
Yeah. So for me at least, and I think I think the evidence would back me on average. Whoever's got, you can usually take any manager and synthesize them down into like 90% computer, 10% noise. And it's unclear to me that the 10% actually adds any value, but it for sure adds a lot of risk and a lot of human elements. So for me, if I can take a basic concept or like an idea that I think is evergreen or based on first principles, and I can implement, let's call it 90% accurate with the computer, and then eliminate a lot of my personal baggage, my emotion, I get stressed out, whatever it is, like just being a person. And I could just use a system. To me, that's more efficient, more transparent, and easier to stick with, as opposed to like getting involved in the process. Because I used to do that for a long time. And the problem is when you get involved, you get ego, you get emotionally tied to different things.
You
And
want
it's
to reduce the human element to the minimum.
Yes, and even to me, even if it may have potential benefits for me personally, it has a lot of baggage. So on net, I'd rather just, even if we just assume the computer can only get 90% of the way there, I think 90% of the way there with high confidence and discipline is better than 100% of the way there. But like taking away a lot of discipline, adding in the unknown element of what about this? What about that? And I'm not convinced that a computer system can't just, replicate most people, and it can definitely do it way cheaper.
Wes, I think you're bringing months. I think you would probably, correct me if I'm wrong, I think, but in most cases, the quant strategies will do much better than of the value manager. It's not like you're giving anything up here. If
Yes,
mistake me
well,
if I'm
and
wrong.
yes, so I'm just
Correct me if
operating
I'm wrong.
under so empirically, that's what you usually see, right? Like it actually is the case that the computer in many domains and many tasks can actually end up doing better than the people, right? There's an outlier here or there, but on average, if you take your group of experts, a computer implementing essentially like a similar strategy is going to on average do better than them. But a lot of people just can't live with that logic. And so I say, fine, let's just assume they're at the margin, maybe in expectation, they have some edge that we believe in, but we also got to manage that edge against the potential costs that they go crazy. And so if we just assume away that they have some benefit over the computer, which empirically we already know is not true, to your point, I still would rather do the computer, because at least I know what I'm getting every time, and I understand how it thinks, understand how its reactions are to chaos. And so for me, that's just beneficial. And then, that's not even to pile
So
on with the
what's
actual
your take
evidence.
on AI in this regard?
So I think AI I think it's great. I think, and I think AI, if you look at most of those
Do
systems and
you
how do
think
they,
that in the
Mhm.
future we will have an AI that will create some value indexing or some EDFs and will tell you, Wes, no, your EDF is not the best. Let's do a better strategy because I calculated the data and it's better?
Yeah, I mean, people already do that, and I think what you see is most of the time when I mean, obviously with AI, you got to make sure it's like the training, and you got to have the out of sample. We just don't have enough data, like in enough, like the problem is we don't have enough samples for like AI to really turn on its mojo, right? Like maybe if you do like high frequency trading, where like literally you get like bet, result, and there's billions upon billions of those and they're generated every day. That's where the AI systems can get incredible. The problem with like long-term investing is we only have so much data and so many training samples. You don't have enough data to really convince you beyond a shadow of a doubt that what the AI is doing, and if you do the AI, like most of the time, guess what they find? Factors. Like, hey, you should do momentum, you should do value, you should do this. And the problem is we need to have like 10 million years of additional data to like, to get confidence that should we do something different? So I think they're great tools, but in the end, I think they're going to just guide you to the exact same thing we already know. Because effectively, through like crappy AI, a bunch of PhDs have been sitting there, mucking around with, the crisp data tapes for the past 70, 80 years. Yeah, it was an inefficient, machine learning algorithm, but that machine learning algorithm, which is essentially all the collective, research papers that all the PhDs have been doing, has already determined what AI we already know determines, like basically do momentum, do value, do this, do that. And the only context I would say where there's probably more frontiers for that is in that high frequency stuff where, like, bet resolution, there's billions of those. And that's something where obviously that technology I think could be useful for sure.
Me and Yoav mentioned it before a lot about your paper about even God would get fired. I think it's one of the most, it's someone, people should read it, I mean, once a week in order to understand, because it shows how difficult it is as a consumer to make good decision about choosing your money manager. What are your best insight from this paper? I
We'll
mean,
put a link to the paper in the show notes.
yeah,
Probably
and give us the
your most
great
quoted
insights that
papers.
you have from what chose it, because it's like
Yeah.
it's like make things impossible to be a consumer in the
Yeah.
finance
So
arena.
yeah, I mean, what it is it all. So the main, everyone will always tell you, hey, the key ingredient to being a good long-term investor is you have to be disciplined and stick to a process. You can be told that a million times. It's just like, hey, you want to lose weight, eat less food and exercise more. It's like, it's obvious. The problem is it's hard to convince people that this is true. And so the God experiment is like, let me just explain this through you through a different lens. Let's pretend you are God and you literally already know what wins over the next 5 years. Let's look at that portfolio, and I will highlight that even God, who can literally cheat, will have situations where he underperforms and loses money. And it just to overemphasize that discipline and sticking to a process is all that matters. But like, you just have to believe us because even perfect foresight has the same problem. And so, but then of course, as a consumer, that gets you in a conundrum. Well, like, crap, like even if this person I'm hiring is literally God, I'm going to be worried about having to fire them at some point. And so that doesn't really mean we got like a great conclusion here, but that's why I always tell people, listen.
So give tips, give our listener a tip how to choose their money manager. Besides Yoav, of course, they can choose Yoav. But
Yeah.
or Wes's funds. We'll put a link to your
yeah,
website and your
or
ETFs, of course, without
But if you
recommending.
want to choose a financial manager, what's the key? Because let's say that some of them are not very professional and some of them not so good.
Yeah.
So how you choose the right financial advisor?
Yep. So I think you want to look at obviously their process and understand how they think about investing and their how much humility they have, right? If someone has a well understood, documented, and they can explain it on the back of a napkin process, and they have a characteristic and a culture of being humble and not thinking they're so awesome and so great, those are usually two aspects, like good process and humility. It doesn't even matter exactly what the process is or how they go about it, but someone who's humble and someone who has a process, you at least know they're contained, right? Where you get problems is people that are not humble. They're great at selling. They're very overconfident. They're like a chameleon, and they don't really have a good process. Those people end up dying in the long game of investing because they don't even know what they're trying to do, and their whole world is around like how awesome they are, right? And they're just, they sell one thing, it doesn't work, great, we're gonna go sell you the next thing, and that's just Wall Street effectively, right? Like, look at iShares. You can go back to the Wayback Machine and you should just do snapshots every year of like the iShares website. It goes from factors and then it goes to ESG. Now it's on crypto. Like all Wall Street and our whole business is designed to do is to sell you what is easy to sell and what can convince you to give them money. But that is not humility and that is not process. That is called marketing. And so we as consumers of financial services need to think, am I being marketed or sold to, or am I being educated on a process and an ethos by people who are trustworthy, have humility, and can just tell me the straight answer? right? And they may have terrible performance. Like when we were talking about, like we have a lot of funds that have horrific relative performance. And you know, I tell people, listen, you know, we have a process. Here's the logic. Here's the first principles of why we do it. We've never promised you anything. We just promise you that this is our process. This is why we do this. We understand that it may work, it may not work. We put our own capital into it, and you know, it is what it is. We have other processes that sometimes do work, right? But it's not about like how you performed after the fact, because there's so much noise in the system that there's always going to be the triple Qs. I always tell people the triple Q index, right? The triple Q index is literally a process.
For our listeners who don't know, the triple Qs are basically the ETF on the NASDAQ.
Yeah. And so the logic behind that is like 20, 30 years ago, they said, hey, if you're traded on the NASDAQ exchange, you're going to be part of this index. It has nothing to do with anything. It's like dart throwing. Triple Qs have, I think, outperformed every single ETF on the planet Earth risk adjusted over the last 20 years. And it's literally dart throwing. So there's always a chance that there's going to be a dart throwing monkey that outperforms because of the noise in the marketplace. But the problem is, process is what on average drives results. So I want to know, what do you do and why? Because I know directionally on average, that's where I'm going to end up. Where it's called resulting. Like Annie Duke has this, I don't remember what her book's called, but this idea of resulting is if you only look at the result, that's not going to help you. You want to know the process, because process is what leads to results. Results don't lead to results. That's why on every single thing, at least in the SEC, they say, you know, whether it's a hypothetical or even live returns, past performance is not indicative of future performance. What is indicative of future performance? Process. Because that's the only thing you can control. You can't control performance. That's what market gods deliver. So anyways.
Gilad, will allow me the last question before let Wes go, and it has to do with what we do here. And I heard an interview, Wes, let me know if you've checked about this lately.
Sure.
What we do in our portfolio, sorry again for the personal stuff, is we know that we've learned about the problems with the quant value investing. So when one portfolio, not only we do the various factors, we combine it with compounder-like companies. So do like quality separately and the value. Why am I asking you this? Because I heard you probably know Dan Rasmussen from Verdad. And he came up with an interesting point. Of course, growth is unexpected. It's very tough to know. But he said companies with high ROIC, high returns on invested capital, over time tend to somehow keep up high ROIC. So, and I wanted to know, have you made any studies on this? Like any, like what we talk about, maybe moats? Any studies you have? I'm not sure. I don't remember if I read anything.
No,
that
for
makes
sure.
sense
That's
about this.
Yeah, that makes
and
a lot of,
combining that with value portfolios. Anything that makes sense to you?
I think there's an aspect of that like those sort of things are sticky in the short run, because usually a firm, they're going to try to like build their competitiveness, build their economic moat. It may take like 10, 20 years for someone to figure out how to engineer around that. That's like Procter and Gamble or Coca-Cola or whatever. But just because something has an awesome economic moat does not mean it's a good investment. It's all about price paid in the long game. And that's usually what people get confused on. But to your point, if you have, let's say, call them compounders or really, really high quality firms, and you're not paying too much for them, and they continue to perform better than even expected because people, maybe the marketplace didn't discount that, that's also a fine strategy. And it's a fine strategy. Like we use momentum to effectively achieve that, because it's going to be way different than your value strategy.
Exactly. Exactly.
Yeah, and so now you get the portfolio benefits of it all. And so that makes sense. So even if the quality compounders, let's say it's not as high expected returns, but it's totally different in yins and yangs at the exact opposite of your value strategy, well, there's also unique portfolio benefits there. And so it could be
people
considered
can hang on to that. Exactly. That was what we were thinking. Wes, we don't want to keep you too much. Gilad, any closing thoughts?
Thank you very much for your time, Wesley. It was amazing. I think we could have talked for a few more hours, but it was a lot. Thank you. Very sharp, very correct. Thank you very much for your time.
We enjoyed every minute, Wes. Thanks a lot.
Yeah,
Take care of the grizzly bear.
Yeah, love what you guys are doing, and
good luck
bringing.
with the business. By the way, the ETF business is also if for any Israelis who have maybe a tax issue or something. Also, is it for international investors as well?
It's so if you want to launch a ETF in the U.S. marketplace, because let's say you have like a lot of U.S. investor interest in whatever you do, yeah, I mean that's what we do. We have a huge infrastructure business.
Okay,
So just
Yoav,
reach out.
let's do an ETF on your strategy and start selling it in the US. No problem.
In
Definitely.
the
Yeah.
US, in the US, you don't need me. You have Wes's stuff. It's
There's a lot of products over here, but you
Well,
never know.
I think your stuff is doing pretty okay, if not a little bit better than the West stuff.
I love it.
I've learned from the
Great.
best. I learned from the best. Wes, thank you again.
Yeah.
It's a
Thank
great
you. We'll
honor.
send you for
Have
your
a
next
great day.
meeting.
All
Thank
right,
you
we'll
very
see you
much.
guys.
Bye bye.
Bye. Bye.